Okay, so there used to be a time when I'd go on vacation and the market would go haywire. So that's not the case. I didn't go on vacation today. I did meet with Brandon with some tax planners to figure out how to get our business started and up and running so we can get going with you guys. So if that's the case, we'll hold off on any more of those tax planning meetings until we get the market back on a solid footing. I'm going to break down what today means. Is this the start of sharp declines? What can we expect in the near term? What can we expect in the longer term after a day like today? I'm going to break all that down. What's driving it? What does that mean? How we can take advantage? Let's go ahead and get started. Today is Friday, February the 2nd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that found us that are watching for the first time. Maybe you're trying to figure out this crazy day today and you're looking around YouTube for some kind of market outlook. I'm glad you found us. Keep coming back and watching day after day as we break down what to do going forward from here. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. There's a red button down there. Hit subscribe. Hit that bell icon right next to it so you're always notified when these videos are posted. Also, while you're there, hit the thumbs up icon right next to it. That lets me know two things. Number one, that you got something out of the video today, that you liked it. Number two, it tells me, you're telling me, David, will you do this video again Monday? Or Brandon or whoever, right? Will you do this video again? If you want me to, hit that thumbs up icon. Scroll down further and comment on anything that stood out to you from today's video. There's a lot of things we have to go over. What did you get out of it? What light bulb moment did you have? What did you learn? What were you reminded of? Let me know. In the video description, I've highlighted a link to join my daily email newsletter I send out every day with hyperlinked timestamp summaries of everything we talk about in these videos, including lists of clusters, overbought and oversold clusters from the S&P 500. So join the list by clicking on that link there. Follow me on Twitter for more content in addition to these videos throughout the day, throughout the week. So get that content, even if you're not a Twitter person. If you want more content like this, follow me on Twitter. My address is up there at the top of the screen. Always pinned to the top of my timeline is tonight's Market Outlook tweet. Like and retweet that. The more you do that, the more Twitter will keep pushing you all of my stuff, as well as Brandon's and Market Scholars. So I appreciate that, and I get a benefit out of you doing that because the more you like and retweet my tweets, especially in this Market Outlook one, the more Twitter will promote it to everybody who follows me to make sure that they're getting it too, because it's an engaging piece of content. Also, Twitter will promote it to other people that like that kind of stuff. If they're interested, because it's an engaging piece of content. So that's the benefit I get out of you simply just clicking the like and retweet. And if you want a link to get straight there, in the description down below, there's a link that will take you straight to today's tweet. So you can just one click while you're watching, one click, like and retweet. Finally, join the Market Outlook community with others that watch these videos night in and night out. The address is up there at the top on Facebook. Join that there. There's also a link that will take you there too, down in the description below. All right, well, let's take a look at the S&P 500 first of all. And of course, now we have to move this near-term low point because we're still in the process of forming it. So we'll move that down there to what is now around the 50% Fibonacci retracement of the near-term run. So let me put this in perspective here. The current drop that was just like unbelievable today, right? And put into the whole week's context, it was a huge, we more than declined last week's rally. In fact, we've basically lost 2 weeks, more than 2 weeks worth of rally. So let me put that in perspective. That this week's decline, which is crazy, has barely crossed the 50% Fibonacci retracement of the previous bullish near-term run. So, near-term run, like runs that typically last 1 to 3 weeks. Now remember, that near-term run lasted pretty much 4 weeks, right? It lasted, 20 some odd days before the near-term line finally fell below 50 here. So, that near-term rally, we've retraced a little more than 50% of it in a matter of 5 days coming off of the high. Now this is bullish as last week's candle was. This week's candle is just as bearish. We started at the high, we finished at the low, so pretty bearish candle. But let me dial it back a little bit. the current intermediate run that we're on, this insane intermediate run that, now we have a weak bearish posture, obviously, with an intermediate line down. That started, over 5 months ago now. And then barring, we've got an extreme low. This is the first time we've got an extreme low on the momentum line below the 5th percentile. We are hitting the 23% Fibonacci retracement. That minor, see, these are the major ones right here. There's going to be some support around that 2700. This minor retracement level is what we're barely hitting with this extreme drop. And you remember we talked about before, and we'll see here more in just a minute. The bigger the extreme drops are, it's hard to maintain this kind of a sell-off when it's so extreme. We'll talk about that more in just a second here. But the idea being is already this is finding some support from multiple Fibonacci areas, as well as, if you can see, the 6-week moving average that we're sitting close to. Now, we have a weak bearish posture. It doesn't seem like weak bearish posture, but like I've mentioned before in previous videos, the near-term pullbacks will seem bigger because the rally was so big. So this, nobody complained about how big that rally was, right? We're complaining about how big the drop was, and these, that seems to be the perception. But nobody complained about how big the rally was, preceded that, much less the 4-month move, where we rallied, off this intermediate low point, a matter of 5 months, 4+ months, almost 5 months. We rallied 18%. 18% in a matter of 4 or 5 months. So, we don't complain about the extreme moves to the upside. It's these moves, but that's why I'm here, is to put these moves in the context. Yes, it's a big move. It's a big move we just had today and this week. But it's only big on an absolute basis. On a relative basis, you can see where it fits. And it's not that big. Now, we'll look at more charts here in a second, and it'll be more bearish than any of these other pullbacks we've seen. But when you get these bigger extreme moves, it's hard to maintain the bigger extreme moves. The posture is bearish. Any new positions, we account for this weak bearish posture when we're looking for bullish positions. We're not too extremely bearish either, because again, it's a weak bearish posture. And the intermediate line's so high, it's still well above 80. So, we talked about there's going to be choppiness in this area here. Well, this week we got some choppiness, and we could very well get some choppiness back up next week for all we know. Right? So expect more near-term volatility. Expect more ups and downs, more ovals to occur as we chop in this area, and these longer-term moving averages in just the 6-week start to catch up a little bit to it. We'll take a quick look here at the other major indexes. You can see the Dow Jones Industrial Average looks exactly the same. Hey, we broke a trend line, but that was the third one, right? We still got some support below the moving average at this trend line here. Weak bearish posture, extreme low on the momentum line. You notice its near-term line is not so low. In fact, a little bit of a divergence potential setting up there. The first low point in the near-term line below the reversal zone. So depending upon where that low point ends up, if we bounce up here, then the divergence would set a target up to that high point right there. And again, I'm not expecting us to bounce up to new highs and let's keep going here, right? Because it's a weak bearish posture. We haven't had a significant intermediate low point formed yet, even with this move, at least yet. So, when I expect any kind of short-term bounce, I'm not looking for new highs. I'm just looking for more near-term highs and more near-term lows than at the pace we have been getting, if that makes sense. And then finally, NASDAQ Composite, still above its 6-week moving average, barely below 80th percentile in the intermediate line, extreme low in the momentum line, very similar there. And then finally, the Russell 2000, which has been already bearish, right? Its intermediate posture was already bearish. It's been lagging. You can see it's had the bigger drop, but you can also see there's some old highs in this area that can hold for a support level if we were to bounce off this extreme selling that we had today. Extreme low in the momentum line. Its intermediate line is almost below 50, but remember, it had produced an intermediate low point here, whereas the large cap index hadn't. The Dow, the NASDAQ, the S&P hadn't formed their intermediate low point there, had been more bearish. And so even here, if I were to, let me get rid of these Fibonacci lines here and draw, Drives me crazy. There we go. We'll draw Fibonacci's instead from this intermediate low point to this one. So again, you can see where that 38% Fibonacci and 50% Fibonacci retracement can hold for some support here on this intermediate run, even though it's not as long as the S&P's intermediate run because of that low point here. It's still, this selling that we've had this week still has not like broken below the 50%, which is where you say, okay, you break below the 50% Fibonacci retracement, higher likelihood that we don't bounce up to new highs. Now, I don't think we'll bounce up to new highs anyway because of how bullish we've been and this divergence setting up, like on this chart here on the market sentiment. And if we do, it might be slightly higher highs, but nothing major. I do think this year, obviously, we're looking for some decent moves because of how bullish we've been and all that. But in terms of like near-term volatility right now, I'm expecting more near-term highs and lows while the intermediate line pulls back, not just on the Russell, but all the major indexes. We get a new higher intermediate low point, which even for the Russell, even with that near-term low, much less coming off of this one for all the other major indexes, would still be a decent probability of a continued bullish trend if this were to flesh out to more of an intermediate low point here. So again, expect more near-term volatility as we produce a new intermediate low point that should be higher than the previous one, right here for the Russell, over here for all the rest. And then as we bounce off of that, it's not going to be nice and bullish like we've been here. This has been an anomaly. Expect more of the 1 to 3 month intermediate runs, more volatility in 2018. It will seem crazy because of how unvolatile 2017 was, but will actually be pretty normal from what we've seen. And you watch these videos day by day, you'll recognize those patterns because we talk about them all the time. All right, so from a long-term perspective, look at the candle for this week and how it compares to the last couple of weeks. In fact, like I said, about 2.5 weeks here is we've more than lost the last 2 weeks and into that third week. But you notice we're still above the 50-day moving average. And look at what it did. This week's result did to... Now, granted, next week we'll get a new line, so it's going to be lower. But you can kind of see what this did to the gap from last week to this week. And depending upon where we finish next week, how much lower it's going to go. But you can see how long it will take for this to drop to zero. It doesn't typically... Here, let's go back, longer time frames. From their peaks, from their highs, you can see it takes weeks to get to zero. Weeks. And there's lots of ups and downs in the process to get, from their highs whenever this line peaks, if this ultimately ends up being the high point, which, a good chance that would be the case considering how high it is. But you can see here, that one never did get to zero back in the 90s. If I were to go back even further, into the mid 90s, where a lot of people are comparing like this to 98. You can see here again, this line peaked here in early 98. There was weeks before we finally hit a new crazy all-time peak that caused that such a big drop so fast. And the same thing here in 99, you can see we peaked right there. And yeah, we had some volatility, but look, weeks before this line never did get to zero because we just kept pushing up to new highs throughout all of 2000. And of course, and here's another one here, another peak where we never did get to zero, but we had more volatility. So again, there's going to be more volatility in 2018. We've talked about, I've tweeted about that, but we're not going to drop down to the 200-day moving average that quickly, right? This line's not going to drop down to zero. And of course, anything can happen, right? So, anything can happen, can throw all this out the window. But according to past precedent, we're not going to have those sudden declines. And when we see declines like this, like we've seen in the past, then we typically bounce off of those. Maybe not to new highs, but we'll typically bounce off of that. Just like the things that moved up the most pull back. And during times like this, the things that drop the most will bounce up during declines like this. If you take a look at the 3 green arrow chart, you can obviously we got 3 red arrows. Now, if this were a stock, and we talked before in the past, when you have 3 red arrows, that on an uptrending stock, the rule is to move your stop order up 3% below that low point, and we bounce off of that, and away we go. if it continues the trend, right? It doesn't have to be the case. Things continue to drop. Even the ones that, even stocks that start a bearish trend start with 3 red arrows. So one of these 3 red arrows will start a bearish trend at some point in time. But more often than not, when you get 3 red arrows like you did here on an upward trend, you bounce. And that's, and again, the reason why that was, it doesn't look so bad as this one is because we weren't so high above the 30-day moving average then as we were now. So again, the reason why this decline looks so big and feels so bad is because of how big the rally was ahead of time. So people who entered a lot of bullish positions here as we were turning bullish, not feeling the pain nearly as much as people who put in positions here. Now, we've been putting in positions here on these videos, and like I mentioned before, when you're walking a tightrope that's just a few feet off the ground, you can be a little riskier, right? You can turn around and do 360s and maybe even flip. But if you're walking up Twin Towers, a tightrope between the top of the Twin Towers, you're not going to be so risky. So you're going to manage that risk with smaller. So any positions we enter here should be smaller, much smaller than what we enter in when we're coming up off of intermediate low points. So I've been making that point before. I'll reiterate that again. So if we are feeling pain now, it's because we didn't take advantage of this point back here, and our positions, our new positions that we've entered in here, have been too big. And remember, the typical intermediate runs 1 to 3 months. We've been 4 or 5 months, and I've been highlighting the 4 or 5 months, which is a risk factor we account for with smaller position sizes. So hopefully that's ringing a bell, and those kind of words that seems like I repeat myself over and over again during these times, almost to a detriment. Hopefully they're coming through now, and you're seeing the reasons why I keep repeating something that doesn't seem so necessary during these strong bullish periods. But obviously 3 red arrows below the 8-day moving average. Have been anyway, but now below the 17-day moving average. And whenever you cross below so sharply, you see an example right here. We went down a little bit more, but we don't plummet. In fact, that was the extent of the intermediate low point there, and we bounced off of that for a multi-month run before pulling back to a new intermediate low point. So, in this case, it's different because we're, again, that much higher, and we haven't diverged really with this strong MACD. So we are below the moving average on both of these, but at some point in time, I wouldn't be surprised if we rallied back up and formed a lower high point because of how fast we've dropped, and then continue to grind, even from here, grind its way down to zero through some ups and downs. All right, so when you look at the intraday chart, it looks like a bloodbath here, doesn't it? I mean, we were just at 283 yesterday, and now we're at 275, so 8-point drop. So, let's zoom this back out to the 2-week chart, and you can see now we are in the lower half of the chart because we have to move up that bottom half. Let's move this up to, let's see, where was that? Here. You can see here that, we are below. In fact, we kind of dipped below that 277, which was the midpoint. Now because we moved up the 4-week low point to January 5th low, we're about, right 279, 278. That's our midpoint, and we're obviously below that. In fact, we dropped sharply below that here this morning. Got below it, retested, came back down. So now we are in the lower half. So things are going to get more bearish. I mean, we're going to get a bearish posture. We're going to get an intermediate low point. Usually not this hard off of lows. In fact, if I were to go back to a 1-year chart here, you can see the volume today, 172 million. The range, we have to include the gap. We closed at 281.58. The high today at 280.23. So about a point and a quarter of gap. Add on to almost a 5-point range as it was. So we're looking at about 6.25 points, almost 6.25 points of range today. 6.25 points with 172 million shares traded. You can see the last time we had a day like that coming off of highs. Now we weren't right at the highs; we were down a little bit, but right there, here in May, we had a lot of volume. May 17th, a lot of volume coming off of highs, and that's how we recovered from that. Now I don't think we're going to have that kind of a move up to new highs like this, right? Because we were coming up off an intermediate, we were only a month away from an intermediate low point. Here we were 5 months away from an intermediate low point. So not expecting a new multi-month intermediate trend here, but I am expecting a bounce, a sharp extreme oversold. In this case, extreme oversold in a small time frame, but a bounce up off of this levels. Then we'll get some that near, we'll get the highs and lows near some volatility. We'll produce a range typically. Now we've got, the 4-week range here. If we were to move this up, even, past these lows up to this one, we've got a new one. We've already got a new, so we can bounce off of this, and it's still a wide range to trade in. We won't shrink that range until that comes off the books. So that kind of gives you an idea. I know it seems like, man, the market's going to go up every day and never goes down, and now it probably seems like now the market will never go back up because it's, it's got to come down from all these losses. Precedent has shown that when you get extreme sell-offs like this with such big volume, such big range we haven't even had a 5% drop from all-time highs yet. We're still hundreds of days since that. So, this is we're 3.5% off of these all-time highs. So precedent has shown that these kind of big extreme moves, if we buy the dip typically on that kind of a move on an intraday basis, then this kind of a buy the dip phenomenon doesn't produce new intermediate trends, but new near-term highs at least. Looking at it in context, again, 172, the high range right now, and we're at the highest point for the 52-week average, for this 4-week average here. The high point for the 52-week range is 100 million. We had 172 million, so very, very extreme. And you can see we're at the high point of the 52-week range too, for the ATR. Under 2.5 points, we had over 6 points of range, including the gap. So those are extremes, and we've seen extremes. In fact, a couple of years ago, we saw an extreme. In fact, a lot of people are talking about this is the worst day since Brexit, since the Brexit vote, which is right here. So again, it wasn't right off of the highs, but it was an extreme amount of volume in a couple of, just a couple of days, and in a matter of 4 days after, we bounced right back up. Now we did again go up to new highs from there, but then we piddled around for a while, and that's kind of what I'm expecting is a bounce back up, maybe not to new highs, but then piddling around with more near-term highs. So lots more near-term highs and lows in this area, especially with volatility bouncing up as much as it did. So volatility now is higher than it's been over the last year. This is the highest closing level for the volatility index in the past year. So big, big extreme moves. In fact, you have to go back a couple of years. You have to go back to Brexit, when we got up to 20. Now, in the election, we also got up really high. But since the election, this is the highest point that we've gotten. See these other extremes, one-day extremes like this, the volatility drop back down. So until it doesn't, that's kind of the precedent we look for to see that it follows. You take a look here at the relative volatility. We're closing above 1. This is the first time we've closed above 1 since April. In April, we closed above 1 on the volatility index for a day before coming back down. It's a little slower, but it took a couple weeks, but we came right back down there to those extreme lows, just like that. Well, this is what volatility looked like back last April. We got up to here. We had a spike, and it wasn't a one-day phenomenon like these others in August and May. It took a few days, but then within a week, we were right back, or a couple of weeks even, we were right back down to 10, much less 11 there. So, so again, this can pile on itself, and we could spike up to 30 for all we know, right? But what we've seen in the past is it usually doesn't happen from these levels. We usually now will come back down. Now we might come back down to a higher low point in volatility. I don't think we're coming back down to below 10. I don't think 2018 will see a sub 10 VIX. I could be wrong, and it wouldn't be the first time, but I don't think we'll see below 10 on the volatility index for 2018. I think now, kind of like what happened back in 2007 and 2008. If we go back to 2007, eventually, there we go. So we have to go back further than 10 years. It's been that long. Jeez, it seems like it was yesterday. Okay, so here you can see 2006 was a crazy low volatility period, right? And then 2007, we got a spike up to 17, well, 18 and a half. That was on some China numbers. And you can see the next week, volatility dropped all the way back down to 14, but we never did get back down to 10, to the low teens, right? The low point for 2007 was right there, right in about 12 and a half, 13. See how the low point took it up a notch. Now the market itself, the S&P, it peaked. The peak for 2007 was right here in October. That was the peak for the market. So, and the volatility index was at 17. That was the highs for volatility during that 2005-2006 run. So I don't think we're getting to low levels again. Just like in 2007 we didn't. I don't think 2018 we didn't. But I do think we'll get a new high sometime in 2018 above where we're at. It might not be in a week, might not be in 2 weeks, but I do think, based on what we've seen in the numbers I've tweeted to you, 2018 will still be a pretty decent year. There will just be more volatility, as we've already seen in a matter of a month and a few days. All right, now let's talk about what's driving the price action today. And of course, the biggest thing driving early this morning was the jobs report. The jobs report came out. The number wasn't bad. It was better than expected. Wage growth here, the average hourly earnings was up, just as it was. The year-over-year change, which is what matters the most, was up too. You can see the year-over-year growth in the non-farm payrolls isn't growing. It was a decent number, but it's still dropping. It has to drop. You can't. You're getting fewer and fewer unemployed, so it's kind of hard to create new jobs when there's fewer and fewer unemployed. So, and it doesn't have to drop to zero, right? It just won't grow at the same year-over-year levels when you're coming off of more unemployed numbers. So that's the situation there. Consumer sentiment, this was a final revision, so it wasn't anything necessarily that moves the market, but still very strong. You can also see factory orders that came in. So remember the ISM surveys, the Chicago Fed, Philly Fed, all those surveys, those are all sentiment surveys. You ask businesses, hey, how bullish are you? Hey, I'm really bullish. Now, what kind of business are you doing right now? Well, we're kind of waiting and seeing, but we're really bullish, right? That's the difference between actual orders versus a sentiment survey. Well, you can see the orders still very strong and have been since the election above 5% and staying high. So very strong month-over-month figure. And you take a look at GDP estimates are strong. The economic surprise index has been pulling back, but kind of halted at these what were high levels before. So yeah, we've pulled back from 80, but we're still at pretty high levels relatively speaking. And you can see what it's done for rate hike expectations. This is for June. This is for the one rate hike in March is 150 to 175, and that's what we were expecting for the last couple of months. Only one rate hike by June, if at all. The purple one was that we wouldn't get one at all. So there was a period of time where the market was expecting any rate hikes, and past this where we're at currently. By next June. And you can see now we're expecting not only one in March, which is the red line, but two by June, and a second one in June, and that's rising up. And then of course here's your one in March. The 150, 175 is almost 80%. So pretty decent odds now. We're going to keep getting rate hikes, and you see that coming out of some Fed speak. So what impact does that have on the asset classes? Well, since the beginning of the week, you can see here that the dollar's strong. The dollar is safe haven asset class. Didn't rally this week, but it outperformed all the other asset classes. Look at emerging markets, and again, if I were to zoom out to a 3-month time frame here, you can see emerging markets and energy were your biggest gainers up to last Friday. They were the biggest gainers. And small cap index or the large cap index too. There. So now let's go back to just this week. Give it a second here. And you can say, okay, well, emerging markets pull back, not surprising. Let's see right here. It's one more. There we go. Emerging markets pull back. Okay, that's not surprising. The dollar bounced, not surprising. Couple things that did not occur, like long-term bonds had been weak. They're still weak. And that's part of the problem that we've had today. One of the issues for the bearish stock sentiment was that you had the 10-year yield. Give it a second here to load up, and we'll just pull back up the regular chart. Up to 2.85%. So in a matter of 4 weeks, we've gone from 2.4%, which we had broken out. That was a breakout at the end of the year. Pulled back down by the end of the year, 2.4%. Now up 450 basis points in a matter of 5 weeks. So, this first 4 weeks, the stock market rallied with it, But once you got above 2.6, then it was like, that's now we're getting a little too far too fast. And again, the bond market can do that, but when it gets up too far too fast, it can come down. But if it does come down, I don't see it breaking back below 2.6. That was a strong resistance, obviously, considering the velocity of this breakout. That will act as a support on the way back down. So that's an issue. But you can also see energy, which is the other side of the coin, right? The higher borrowing costs from with bond prices rallying so far so fast, and then you add on higher commodity costs or energy costs with crude oil holding its gains. So it didn't drop. It had a good 3-month return, but it didn't drop this week as much as it could have. You can see it's down 1.5% and actually outpacing gold, or kind of matching gold, outpacing stocks. And you can see large cap stocks and small cap stocks both falling about the same pace. But you remember how much of an outperformance large cap had over small cap. And you can see high yield still outpacing, high yield corporate outpacing treasuries. So that spread, in fact, that's the treasuries really dropped, and that's not a risk off type of a. Usually people, when they're really risk off, they will buy gold, they will buy the dollar, they will buy bonds, at least to the extent more than their corporate, because corporate tends to behave like stocks, and you can see that wasn't necessarily the case here. They were still willing to, and they sold off corporate a little bit, but not half of what they sold off government treasuries, long-term treasuries. Of course, the other news that came out that drove markets is the release of this memo from the FBI. And so there's some chatter that can affect things. And again, it doesn't affect the economy or corporate earnings or anything like that. It can affect sentiment. The higher the valuation is, when you are walking a tightrope between two twin towers, you can get across that tightrope. That can happen. But any little wind, any little headwind can push you off. And even if it's a FISA memo that you would think would have nothing to do with the economy or whatever the case is, any little wind can push you off when you have when you're this far up off the ground, when your margin of safety is that low. So that's the problem, and that's again when you get up so much, the downs will be bigger, and that's reality. And so when you're up so much and you're up off those lows so much, there's a lot of risk down. We can't not trade because we were up this much off of the S&P 500 for weeks. I mean, the fear of missing out thing that's been so prevalent lately. We just have to account for the higher risk levels with smaller positions, smaller trades, and then this concept of portfolio risk, where if I were to get, you don't want to be all directional one way or the other. You want to have a good balance to balance out that risk as well in your active trading account. Obviously, your longer term investing is all going to be bullish, most likely. But in your active trading account, as you get to this extent, you have that balance. We've talked about that before. You don't have to be, you still want to have, follow the trend. You still want to follow the posture, but you have that balance in there. That will help offset when you have a move like this. But, we can very well bounce off of this, maybe not to new highs like we bounced to new lows this week. I don't think we'll bounce up to new highs, but we can very well bounce right back up off of this. And don't get caught in the trap of thinking, okay, we're good again, if that were to occur. And if it were to keep dropping back down, remember, we're just 23% Fibonacci retracement of the intermediate run. The more we drop down, the more likely we'll form that new intermediate low point, which is, right now, much higher than the last one that we've had months ago. And for everyone who says, hey, I'll get back in if I have an opportunity, when it pulls back some. Well, right now we're 3.5% off the all-time highs. If we get to 5%, which for the first time in hundreds of days, then there's our opportunity. Are we willing to take it when the VIX is at 20? If obviously if we were to keep going down, which I don't think. I'm more expecting a bounce, a near-term bounce. Not to new highs, but a near-term bounce next week. But if we were to keep going down and the VIX gets up to 20, there's our opportunity to buy the dip. Are we going to be able to take it when there's quote-unquote blood in the streets? It's crazy to think that blood would be in the streets when the VIX is, but that would, if we have another down week next week like this week, it's going to be crazy. heads will be rolling. Are we going to be able to use that opportunity to get into some stocks that have good long-term trends that are now cheaper on a short-term basis? Will we be able to put our money where our mouths have been for the last year or two and take advantage of the pullback? From a sector perspective, again, looking at the week that was, right now, let's zoom back out so we can see what's been doing well. We've looked at healthcare. We've looked at consumer discretionary, energy, materials, industrials, all at different levels here have had their turn. Healthcare here late had a nice rally late that pushed it up higher. So now with all that context, and then of course utilities and real estate down, let's see how the week has turned out. And you can say, okay, right here you can see, okay, the biggest losers, energy, materials, healthcare. What's interesting is that consumer discretionary is held up. Now, 3% loss, but outperforming the market. You can see financials outperforming the market. You can see utilities outpacing. Real estate also all down 2.25%, 3%, but you can see outpacing the market's 3.75% return. So a little bit of a safe haven. Consumer staples matching, still down a lot there. And again, the reason why those areas are not further up here, which is where you would expect them to be during a broad risk off, is because bonds sold off. Bonds stayed low and yields rallied higher. And of course, if they pull back, bonds and those guys pull back, look for any near-term bounce to be led by utilities, consumer staples, real estate, because they will benefit more from a drop in even just a pullback from 2.8 to 2.6% in those yields. All right, so for our trade idea of the day today, I want to look at ExxonMobil here. You can see after an earnings had a really big decline, in addition to what the market probably did to it. In that energy sector, which had been an outperformer, has pulled back this week more than anybody. All right, not more than anybody actually, but had pulled back some of those gains. Remember, materials, energy, the dollar being weak, you expect those stocks to be outperformers during a late, mature, bullish cycle. Here's an opportunity to say, okay, am I willing to take advantage of the pullback, right, and look for an opportunity, not being too aggressive because again, look at that chart, big sell-off here. In fact, you can see when you look at it on a standard deviation. Let me look. That's your 2 standard deviation. No, that's a 3 standard deviation volume for the year. And you can see there's times, when you have these big spikes, it doesn't keep going. You had a big spike there, it doesn't keep going. Here's a big spike. Is it going to keep going to the downside? Are we going to hold now? That's the question mark. And again, I can manage the risk. If I were to buy a stock, it's 100 delta. If I buy 100 shares, I buy 100 delta. I can buy a call option at 50 delta or in the money at 70 delta with a stop order. So I can do that kind of thing. Or I can just sell this 82.5 put. There's some resistance. We already saw we're well below the Bollinger Band. We've seen before when you get way below Bollinger Band, especially on kind of a big volume earnings announcement, obviously a long lower shadow is going to act as a support. That's 83. You've got all these highs over here around 84. And before those highs, you had highs, right about at this 82.5 level here from before. In fact, you can see it a little bit better on this chart when you include the dividends. You can see that was the old level before. We broke down back above, tested. So there's multiple layers of support at where the short strike price would be, because that's what we're selling. The benefit of the higher volatility we're getting right now is it allows that short strike price to be relatively low compared to where we're at. So you get a pretty decent credit. 30% return on risk, you're looking for about 60 cents, so you're getting almost 70 cents. And then your stop order can be there, and you can see again the strike price is there at 82.5, and there's going to be some support there. At 81.25 is where you're going to lose $55 compared to 69. So really, to lose 69, it's not much further, but you'd have to get down to right in that area, about 81. So about 81.25, you're going to lose. You're going to be at the point where you're losing as much as you were trying to make. A 1-to-1 risk-reward ratio with a pretty decent probability of making anything. There's an opportunity for us not to be too aggressive, but take advantage. in this case, using earnings to really amplify the pullback that we got in an area that had been an outperformer for fundamental reasons and has had a pullback. Has had a pullback this week during this pullback. A way to take advantage and buy the dip without being too aggressive, without getting the bounce first. Here's a way we can manage the risk. You can see the delta is what, 2.6? No, sorry. The delta is 15, so very, very low delta. If we keep going down, I'll lose $15 per dollar drop. So $15, you can see it's a positive theta trade. So if it just grinds away within the range here, I am perfectly okay with that, because the low end of the range is up above the strike price, and the high end of the range, it can go as high as it wants to, and I make the return I'm looking for. So that being said, if you, to sum up, if you weren't willing to jump off the cliff during for 3 weeks into a near-term rally or 4 weeks into a near-term rally, then we shouldn't jump off the cliff when it takes 1 week to get to a 50% drop or a 23% retracement of a 5-month intermediate run. We're still some support levels. This was an extreme move today. Admittedly, this was an extreme move today. But we can take advantage. In the past, extreme moves have provided opportunity. I don't think we'll have the opportunity for an extended intermediate run again, another 5-month run. I don't think this will necessarily produce the intermediate low point yet. I think there's still going to be more near-term highs, near-term lows as we grind away and ultimately produce that intermediate low point. But that being said, 2018 will be a year of more volatility, and if you didn't believe me before when I said it, hopefully after this week now, you'll believe me. And just like 2007, once volatility did start to rise at the beginning of the year, led to a crazy bear market. So, but I don't think we're not in that mode, because we're not coming off of fraud and excess in the real estate market like we had back then. But just like that increased volatility at the beginning of 2007 didn't lead to a bear market then, we continued higher to new higher highs by the end of 2007. That could very well be the case again here. So as always, stay tuned. We'll break it down for you night after night, day after day, so you know what to do and how to do it, how to manage your portfolio. And again, as we get our classes up and running, at marketscholars.com, then you'll be able to interact with us a lot more than just watching these videos, and with ideas and trades and different strategies, from buying stocks to trading options to managing ETF portfolios, all of that. That's what we're going to be covering: actionable plans with rules and with ideas in real time of how to do it once we get those classes up and running. So that being said, have a great weekend, everybody. I hope you all have a great kind of a early spring, at least for us. Hopefully it's not too cold in some areas like it's been. But have a great weekend. Chill, do whatever you need to do to get over what we had this week. And let's look at next week as an opportunity. So come back and listen, and we'll see how we can take advantage. Have a great one, everyone. We'll see you next time.